Okay, let's just dive right into this. Welcome to today's Explainer, where we are tackling the high wire balancing act of investing in mid-cap mutual funds. We're going to use the Invesco India Midcap Fund as our main case study today to really unpack exactly how you can balance risk and reward in this completely fascinating segment of the market. So if you're looking to optimize your portfolio for long-term growth, but without taking on just reckless volatility, you are absolutely in the right place.
Here is our roadmap for the breakdown. We're moving macro to micro. First, defining midcaps. Then, checking Invesco's historical performance. Analyzing volatility, looking at portfolio distribution, comparing benchmarks, and finally, distilling Invesco's strategic advantage.
All right, Section 1, defining mid-cap mutual funds. Let's set the stage.
So by definition, a mid-cap mutual fund is a pooled investment targeting companies ranked 101st to 250th by market capitalization within the Indian equity universe. Now you might be wondering, why does that specific rank even matter? Well, these are mid-sized companies. Think businesses with capital ranging from roughly 5,000 to 20,000 crore. They're actively scaling up. They're totally past that fragile, risky startup phase, but they haven't quite reached the massive, sometimes slower-moving scale of those giant mega corporations. It's a really critical investment tier.
And really, the fundamental tension of the entire mid-cap space is a story of contrasts. You have the stability and mature growth of large caps on one hand versus the high growth potential but moderate market sensitivity of mid-caps. Mid-caps generally offer better returns than large caps over time, but they help you avoid those stomach-churning extreme risks associated with small caps. You're basically aiming for that perfect Goldilocks sweet spot of risk and reward.
Moving on to Section 2, Invesco's historical performance highlight.
Literally, just look at this massive number, 21.38%. That is the fund's compound annual growth rate, or CAGR, since its inception all the way back in April 2007. It is one thing for a fund to promise high returns, right? But it's an entirely different thing to actually deliver an annualized return like that over multiple, highly turbulent market cycles.
And when we break down the 1-, 3-, and 5-year milestones, the consistency in the fund's historical wealth creation becomes super clear. We're talking a 12.24% return over 1 year, a massive 26.93% over 3 years, and 21.53% over 5 years. This absolutely proves that the inception number isn't just some historical fluke. The fund has actively capitalized on market rallies to generate really substantial wealth for its investors.
Section 3, analyzing volatility and risk metrics, because we have to look at the full picture.
Okay, let's keep it real and acknowledge the risks directly. The core risks of mid-cap funds include liquidity risks. These equities just aren't as widely traded as large caps, meaning those bid-ask spreads can widen, which makes it harder to buy or sell at a fair market value during extremes. Then there's market risk. Mid-caps are simply more sensitive to wild market swings. And finally, interim declines. During economic downturns, mid-cap funds can definitely suffer sharper losses than large-cap funds. It's just the nature of the beast.
To actually measure those bumps in the road, we use a key risk metric called standard deviation, which for this fund sits at 17.04. Think of standard deviation as your personal volatility tracker. It measures how widely a fund's returns spread out from its average performance over time. So at 17.04, this fund is showing expected, measurable market swings. Yes, it's volatile, but predictably so for its category. And this pairs super closely with its beta, which is the metric that gauges the fund's volatility relative to the overall market.
And then we have alpha, sitting at a very healthy 6.59. Alpha is the excess return a fund generates compared to its expected benchmark return based on the risk it's taking. So, the absolute crucial takeaway here is that a positive alpha of 6.59 means the fund manager isn't just lazily riding the market wave. They are actually adding significant value through active stock picking, totally beating the expectations for this specific level of risk.
All right, Section 4, Distribution and Beginner Insights. Let's see how this is built.
Let's peek under the hood at the fund's defensive buffer. Now, as per regulatory rules, it obviously has to hold a significant majority in midcaps, and here we're seeing it at roughly 65%. But look closely at the rest of the distribution. Over 18% in large caps and nearly 17% in small caps. The fund manager is strategically using the bedrock stability of large caps and the explosive potential of small caps to perfectly balance the scale and optimize the entire portfolio.
So let's pause the data dump for just a second. We've thrown a lot of numbers around. How can conservative beginners actually use these hard metrics to secure long-term capital growth? Like, what does this actually mean for your personal portfolio strategy if you want to jump in?
Well, here is your exact playbook. First, acknowledge the interim sharp declines are going to happen. Do not panic when they do. Second, invest exclusively through SIPs, or systematic investment plans. Doing this allows you to average out your purchase costs during those wild, volatile swings. And third, commit to a 7+ year investment horizon. If you stretch your timeline out, the day-to-day volatility we just analyzed gets largely neutralized by the incredible compounding growth of these mid-sized companies.
Next up, Section 5, Benchmark and Peer Comparisons. Let's see how it stacks up.
Let's contrast the costs, because fees matter, right? The base expense ratio for Invesco, when compared to major peers like HDFC, Kotak, and Nippon, reveals a pretty stark difference. Invesco sits at 1.46% for its regular plan, but it drops down to an incredibly efficient 0.49% for its direct plan. In a highly competitive category like midcaps, keeping your expense ratio low literally means more of those impressive returns actually stay right in your pocket.
And the long-term returns? Invesco systematically outpaces both its direct midcap benchmark, the BSE 150 Midcap TRI, and the broader Nifty 50 over the long haul. Over a 3-year period, Invesco generated 26.63% compared to the benchmark's 22.49%. Stretch that to 10 years, and it's 17.98% versus 17.90%. It consistently proves its ability to generate that awesome positive alpha we discussed earlier over extended time frames.
Finally, Section 6, the Invesco Strategic Advantage.
Here's the hidden structural power of the mid-cap universe. Large caps are heavily concentrated, sometimes with massive allocations strictly in financials, for example. But mid-caps exhibit a much broader, vastly more diversified sectoral net. The top 10 sectors in mid-caps account for just 40.4% of the index weight. This means the fund manager has a much wider array of stock-picking opportunities across all sorts of different industries, significantly reducing the reliance on just one or two massive sectors.
And this broad net builds directly into a highly specific valuation strategy. The fund actively uses price to earnings, or PE bands, to strike a really deliberate balance in the portfolio. By mixing high valuation growth stocks with lower valuation value opportunities, they perfectly manage that risk tightrope. They aren't just blindly chasing expensive growth, they are carefully blending it with undervalued assets to protect your downside. It's smart investing.
To quickly summarize their strategic edge, it is a totally process-driven, bottom-up stock-picking strategy with a top-down theme overlay. They are out there actively identifying credible challengers emerging in traditional sectors like consumption and finance. They brilliantly balance new-age opportunities with established value companies. And crucially, they consistently capture successful market cap transitions, meaning they are finding the mid-caps today that are absolutely going to scale into the large caps of tomorrow.
Which brings us to our final and maybe most important takeaway. Mid-cap funds reward patience and discipline, but only when selected with the right metrics in mind. I want you to take a hard look at your own investment strategy today. Are you leveraging the incredible growth potential of mid-caps? And if so, are you actually using the metrics we decoded today, like alpha, beta, standard deviation, and long-term horizons, to protect yourself? Keep those exact questions in mind as you assess your portfolio's future. Thanks so much for joining me on this explainer, and as always, stay curious.